Hi, I'm Matt McAleer, Executive Vice President and Director of Equity Strategies, joined by John Mousseau, President, CEO, and Director of Fixed Income at Cumberland Advisors, here in Sarasota, Florida. Today we'll be discussing our thoughts on the third quarter of 2022 and how action in both the equity and fixed income markets affected the Cumberland strategies over this period. Let's get started with three of our broad strategies. Let's initially discuss our U.S. core strategy. This strategy invests specifically in the U.S. equity markets. Currently, we have a value tilt there. Value has been outperforming growth, and that has benefited us versus the benchmark. Another benefit is we do take an active approach in this strategy and have held some cash. We've been a bit defensive. We're currently sitting at 15% cash in our U.S. core strategy. The second strategy I'd like to discuss is our international strategy. Again, an active strategy where we are sitting on approximately 17% cash. International is the devil's word this year. There is nowhere to hide. There is no region that's working.
No.
There is no country that's working. If we look at what worked best over the last quarter, it was in areas in Latin America, and we do have positions there. In terms of our performance, we're in line with the benchmark for Q3. The third strategy to cover in our broad strategy toolbox is our active passive strategy. Our active passive strategy is a balanced strategy. Right. It's 60% equity, 40% fixed income. In that 60% equity piece, it's approximately 2/3 Standard & Poor's 500, 1/3 mid-cap 400. So in terms of equity performance, pressure across both securities, for the second quarter in a row, mid-caps did slightly outperform the S&P 500. And that's not a huge surprise in a rising rate environment. Right. When I go back to 2005, 2006, when the Fed raised rates 14, 15 times in a row, MDY, the mid-cap 400, easily outperformed the S&P 500. Will that continue to happen here? We don't know, but there is some precedent for it. So those are some thoughts on our broad strategies. Let's shoot over to the Moose and discuss fixed income and what rates are doing.
Matthew, it was a tough quarter. So bonds were in retreat, didn't matter either in taxable or tax-free. Let's think about taxable for a minute. Full retreat, 2-year treasury went from behind 3%, 295, all the way up to a 428 by the end of the quarter. 10-year bond, no hiding there, went from a 3 to 383. So what was going on? The markets were reacting to the Fed continuing to raise short-term interest rates. Fed did 2 rate hikes of 75 basis points each, one in July, they skipped a month when they don't meet, and then another one in September. We fully expect their next meeting to raise another 75 basis points, and they're probably not done yet. What has this done? This has meant that the markets are scared of the Fed, and well, they should be. How is that reflected? That's reflected in the fact that a 2-year bond is at a 425, 428, and a 10-year bond is basically 50 basis points less at a 380. That is normally a sign that you are starting to head towards a recession, certainly a business drop-off. And why? Because the banks cannot make any money by borrowing short and lending long, and so they start to restrict credit. In terms of credit spreads and stuff during the quarter, it really didn't, maybe up a little bit, 5-6 basis points. So it was really just a reaction to the Fed and an interest rate rise in general, and not so much with credit yet. On the tax-free side, another mess. Why? Because we've had ongoing redemptions of municipal bond funds. It continued during the quarter. The same kind of ratcheting up. You went from a basically 2-year munis behind 2% to over 3%. 10-year munis, went up from 3.25, to like a 390 or 30 years. And remember, this is just on the AAA scales. Other stuff higher. And in fact, as we sit here today, a week after the quarter, long-term munis of a more generic AA variety are closing in on 5%.
Yeah.
So that is an amazing uptick when you think since the beginning of the year. What have we done? We've extended durations in both strategies. On the taxable side, out to about 6.5, and on the tax-free side, pushing towards 7 and higher, maybe 7.25. Why are we higher on the muni side than on the taxable side? It's because it is so distorted when you think about a 30-year treasury at a 370 and you think about a long muni closing in on 5.
Sure.
That is a market that is bent out of shape, and we're taking advantage of it.
It's the dislocations you look for.
It is the dislocation we're looking for. So we think it's a very attractive time. It has certainly been a rough road to get here.
Thanks, John. Great information. Let's look at our quant strategies. Market vol and leverage market vol. Vol standing for volatility. We use multiple quant inputs to try to guide the strategy to being either fully invested in the S&P 500 or in cash. Q3 we were invested. Not many places to hide within the S&P. Year to date down close to 23-24%. I think it's important to realize that we do have some time period exits approaching. So clients should look for that. When we hit an exit, we go to cash and wait for the next buy signal. In terms of our thematic strategies at Cumberland, we have 2, U.S. Equity ETF and Tactical Trend. U.S. Equity ETF is primarily managed by David Kotok, who tries to focus his work on sectors and industries that have large, bright futures. And in terms of where we're invested currently, our largest holdings are in healthcare, which include medical devices and biotech, as well as defense. Think of firms such as General Dynamics and Lockheed Martin, Northrop Grumman. With what's going on in the world,
Sure.
Not a bad place to be.
And they're giving you really the effects of a life preserver right now, where there's not too many places to be there.
And with the pressure that's been on the market, they did exhibit some nice relative strength. The key to active management, and our strategies are primarily actively managed, is you can raise cash and be defensive at times. David came into Q3 at about 15% cash, and fortunately, halfway through, ratcheted that cash up to approximately 48%. Now that may seem like a large number, but think of how that buffeted us in the back half of September,
sure,
and offered really nice performance versus the benchmark. Tactical Trend is our other strategy. As we've discussed, as active managers, we have a cash cushion there as well. Between money market and treasury bills, we're close to 25%.
Right.
Outside of that cash, there were very few places to hide. Tactical Trend can be in U.S. equities, international equities, fixed income, commodities, all asset classes that were under
Right.
pressure. The one other wrinkle in Tactical Trend is it can hold individual securities. And 2 of those individual securities happen to be the 2 largest non-cash holdings,
Right.
and that's Berkshire Hathaway and Microsoft. And as strong as those balance sheets are, and as well known as the companies are, they were ducking from a nasty market as well.
Nobody was protected.
Nobody's been protected. We will continue to try to focus on cash flow opportunities. John mentioned some recessionary type indicators that are popping up. In a recession, we certainly want to lean on cash flow generators. They can put that cash to work advantageously for future performance. We hope you enjoyed this video and look forward to providing you with more review content on the markets and Cumberland Advisors investment strategies. We'll do this on a quarterly basis. Feel free to reach out with any questions and make sure to visit our YouTube channel, where you can find other relevant content such as our Week in Review series or strategy profiles. Thank you.